Larry, I'll just start with you overall. Just talk to me about where you stand on the markets. NVIDIA obviously was better yesterday, wasn't enough to save the kind of worst day in a year, though, more broadly. And a lot of people are worried about the Fed here.
So a couple of things. I do think technology continues to be a shining star throughout this earnings season. I think what's happened during earnings season has been a microcosm of what we've seen for a significant period of time, and that is that earnings continue to keep pace with the price appreciation of the stocks. But more importantly, you're seeing these companies with incredible profitability, and what they're doing with those profits is buying back their stock. They are increasing or initiating dividends, and then they're investing for the future, so they'll continue to keep their competitive edge. So I still like that tech sector. Okay, you still like it. And I guess NVIDIA, is that kind of a hold your nose and buy it, or buy it, excitedly? And I'm just kind of asking all this about what is the path from here with a $2.5 trillion company. And as Tom Lee was pointing out recently, a tech sector that, or as Mike Santoli said, if you add some of the communication staples companies, 38% of S&P profits already, right? So does that profit share have to keep growing? Is it going to hit 50%? Or how much more bullish can you be? How much more can they go? So I don't talk about individual stocks, but when I look at the tech sector. Yeah, go ahead. Oh, I'm sorry. Larry, go ahead. Oh, again, I don't follow individual stocks, but I do think that when you look at these companies today, a lot of people want to think that they're back to where they were in, around 2000. And they're completely different companies, right? Their profitability is so much greater. Their margins are so much greater. These companies are much more diversified than they were back in 2000. And I think that probably sets up a much longer, runway for them to continue to rally here going forward. So you're in kind of the 1995 camp, that we're that kind of moment in the cycle, it sounds like. Kim, jump in here. What were you going to say?
Sure. Well, I was going to say it depends on a lot of things, but it looks like right now the people who are investing in technology are the technology companies themselves because they can see demand. And I think that's super exciting. And growth begets growth. And I think that is what's happening. So could it become 50% of the S&P 500? Maybe. But at this point, there's a lot of good out there because not only are they entertaining stocks like Netflix and Meta. I mean, I don't think either one of those save lives. But this whole AI thing, it could move into greater productivity and the ability to optimize many things which we can't right now through technology. And that's why I think companies are pouring money into that sector. Yeah. So, Kim, I guess would you, I'm looking through your notes here to see the names in particular. We've often talked about a lot of the Intels and the chip names. What's the strategy now for you, given what AI is capable of doing? Sure. Well, I think it is to wait out the cycle. I think what happens a lot of times in any new technology, like God knows back in the late 90s, 3D printing is something that kind of was a boom and a bust. And even autonomous driving. I mean, I think in 2017, if you would have said, are we going to ever drive cars in 2024 ourselves? The answer would be no, and they would be wrong. And I knew they were wrong because I know this technology takes a very long time to develop. So if you're going to win ultimately in this area, you have to wait a very long time. And we're in the just initial flushes of this. So please don't forget that, investors.